So here's some potential approaches to risk, and this is just by way of an example to show that you can blend together the different risks and perhaps use factor-based approaches and stress tests in the same system. And if you look at these examples here, for insurance risk, for example, it's not uncommon to have the insurance risks dealt with by the stress test regime. I said, apply one set of assumptions, apply another, calculate the difference, because the actuary is usually doing these calculations and they can simply run the computer program twice to come up with the calculation. So it's not so complex in terms of time and cost. The factor-based approaches for premiums and claims and such tends to apply itself a bit more to the non-life case, and in some cases that's because their non-life companies can be smaller, can be more data intensive to be able to do more significant things, because the business is different in nature, and it may be the more practical solution. The catastrophe risk issue, because it is significant for non-life insurers in particular, sometimes can make use of proprietary models and more complex approaches to try and identify what the impact of a major catastrophe would be on the company, and therefore establish a separate element. So it might well be that the factor-based approach can make use of indexes of risk from the balance sheet, and the catastrophe approach may take a different approach. If we look at the market risks, the equity, interest rate, real estate risk, currency risk, they can all use these stressed approaches in terms of saying, well, the company should identify what the change in value would be from a change in interest rates or equity values or such of a certain amount. Or it can use a factor-based approach, which in some senses is kind of the same question. If you say, what if equities fall by 10%? Well, we know that the value would go down by 10%. If it's market valued, we could simply apply a 10% factor, do the same thing. The asset concentration, of course, deals with assets over above a certain level, so that tends to be a factor-based approach to the extent that those assets exceed those limits. Credit risk, a factor-based approach, has been very common for many years, and not really much need to improve that over time. It's been pretty satisfactory. And operational risk also, because of the diversity of risks, tends also to be a fairly broad approach taken on factors for that.